Thank you, Chairman.
Mr. Hines, for 5 minutes.
Thank you, Mr. Chairman. And Mr. Chairman, thank you for being with us, and thank you for your efforts and work over the course of the last several years and to stabilize our economy. Mr. Chairman, I read very closely and listened to your testimony on the things that are holding back our recovery and read that monetary policy report here. And I want to just dwell on them for a minute or two. I saw financial strains associated with Europe, still tight borrowing conditions, the restraining effects of fiscal policy and fiscal uncertainty, and the housing market as the four that you highlighted. Presuming that we're not in the near term going to do a lot about number 1 and number 4, I want to explore with you still tight borrowing conditions and whether there is anything that Congress could do to assist in that. And I know you're hesitant to sort of make prescriptions to the Congress, and I understand that, but of course the Federal Reserve has been pretty clear in their message that monetary policy alone is not enough, so I'm going to explore that a little bit with you. In the report you say that still tight borrowing conditions are a result of uncertainty in the economic outlook and high unemployment. You did not mention uncertainty associated with Dodd-Frank and the rule writing process and the new regulations. Can I assume from that omission that the Federal Reserve, does not believe that that regulatory uncertainty is in fact a material cause of still tight borrowing conditions? And if it is material, should we be doing something about it?
Well, I think so. There are a lot of reasons for it. The problem, part of it is on the demand side. The borrowers are financially impaired from the crisis, and they're not creditworthy or as attractive to lenders as they were earlier. There are other various factors, including, for example, concerns about banks have about having mortgages put back to them if they go bad, etc. So there's a lot of conservatism in lending right now as well. I don't think I would say that there was no effect of financial regulatory policy on any of this. For example, as we try to develop rules for mortgage lending, for mortgage securitization, there's still uncertainty about what the playing field will look like when the private sector securitization market comes back, or if it doesn't.
No, I understand, Mr. Chairman. I'm sorry to interrupt, but again, my question wasn't was there no effect. It was it material? I happen to think that the reforms in Dodd-Frank, many of them are terribly, terribly important. There's obviously things that will need to change over time. I'm really sort of looking for materiality because, frankly, you don't mention it in the report. If you were to say that, no, it's a material effect on credit availability, I might rethink my position.
I think it's partly on us, the regulators, more than on Congress, in that some of these things have not been resolved one way or the other. I mean, a number of people have talked about uncertainty. If we can move to provide clarity about how the regulations will be written and so on, I think that will be helpful. And I certainly agree that the benefit of financial reform, which is to reduce the threat of another financial crisis, is extremely important to take into consideration.
Thank you. Thank you. Second question, in your second reason for headwinds here, the restraining effects of fiscal policy. I wonder if you could elaborate on what you mean by the restraining effects of fiscal policy. How is that providing a headwind to our economic recovery?
Well, broadly speaking, fiscal policy, both at the federal and the state and local level, is now contractionary, that it is pulling demand out of the system rather than putting it in. And you can see that most clearly at the state and local level, where tight budgets over the last few years have meant that at the same time that we're trying to increase employment in the country as a whole, that of course many people are being laid off by the state and local governments. So I'm not making a judgment about that. Obviously they have fiscal issues they have to deal with, but it's just a fact that fiscal tightening, particularly at the state and local level, has been something of a drag on the recovery.
Can I conclude from all that, though, that you're achieving your mandate of full employment? Were we to abide by the policies suggested by some in this institution for more severe austerity now, can I conclude that if we pursued that policy, it would actually not be helpful towards full employment?
Again, what I've been advocating is a sort of a two-part policy, one which makes strong and credible steps towards achieving sustainability over the medium term, over the next decade, while avoiding sharp cliffs and sharp contractions in the near term, yes.
Last question. Drawing on your experience as an economist, there's all sorts of debate around here about the things that we might do. Extending safety net programs, unemployment insurance, tax cuts for middle-class families, tax cuts for the wealthy, infrastructure investment. each of these things, each of these fiscal policies have different multiplier effects, more positive impact on the economy.
Okay.
I wonder if you might just relatively rank the multiplier effects of those 4 initiatives that I just laid out.
No, I think that would come too close to advocating the different approaches, and each of these things has not only multiplier effects, but it has different costs, it has different benefits to the economy, different philosophies about the size of government, and so on. So I think, unfortunately, that's congressional prerogative to figure that out.
Thank you,
Thank you,
Mr.
Mr.
Roy.
Chairman.